to Industry Focus,
the podcast
that dives into a different sector of the stock market each day.
I'm your host, Emily Flippen.
I'm Jason Moser.
I'm Nick Seipel.
I'm Dylan Lewis.
And today we're talking financials.
Today we're talking consumer goods.
Wildcard Wednesday.
And we're talking energy.
And today we're talking tech.
Let's dive in.
Today is January 2nd, and it's our 2020 Energy Preview Show. I'm your host, Nick Seipel, and today I'm joined by Motley Fool contributors Jason Hall and Matt DeLallo via Zoom. How's it going, guys?
Doing great.
Hey, good, doing really good. It's good to be on. Matt, it's been a while, Matt. Haven't been on an actual voice-to-voice chat with you in quite some time. I'm excited.
Yeah, it's probably since like October of 2018, right before the oil market crashed.
Hey, let's kill the oil market again.
Yeah. So the last time we did one of these, the roundtable shows was, as you mentioned, so I think it was last September or October of last year. We had the Writers' Conference here at Fool HQ. As Jason called out, we basically kind of hit the top of the oil market, and folks, that really fell from there. Today, I just want to talk off the top of the show, just kind of the state of the energy industry. So you look back over the past decade. It's been kind of a wild ride for the energy markets. If you look at the S&P 500 energy ETF, it's up 9% over the last decade. But, the first half of the decade, you're up 75, 80% as the beginning of the shale explosion took place. But valuations have really come down significantly. And just a couple of weeks ago, there was a report from Bank of America Merrill Lynch out saying that Apple is now bigger than the entire S&P 500 energy subsector. So, as we kind of look at the energy market today in the context of, what's been a wild past decade, what do you think is the current state of the energy market today for investors?
I'll start off with that one. It's been tough. I mean, if you look at it, you could have done better in like a CD than the energy sector, which is just mind-blowing considering how much energy we use every day. And a lot of that goes down to companies just been like really bad at investing their capital. However, I think that it's changed a lot, and that's why I think it's pretty attractive. Like pipeline companies are just so cheap right now. They're really doing a good job of getting good returns on their projects. Renewable yield cos are another thing that I like. So infrastructure, I think, is a really exciting, looking forward with energy.
Yeah, this is Jason. I'll agree with Matt. Within the confines of, you're talking about particularly oil and gas, the companies that have predictable revenue streams, the pipeline companies definitely. There are a lot that look really, really cheap, and there's catalysts for growth there too, right? If you look at some of the new oil and energy plays and trying to connect places to, connect markets to supply, I think he's right. It definitely carries over to renewable yield cos. You've got a lot of really good infrastructure and like capital asset management companies that have figured out where to make money in renewables, and the companies that their prices are still tied to or their prospects are still tied to commodity prices. I'm looking at you, independent oil and gas explorers and producers. They just seem to destroy capital, and I don't think that their prospects are necessarily as a class, as a category maybe, but I think the problem is picking the winners. And so I think for the most part, investors should continue to avoid those pure plays in the E&P sector and look at the companies that have the predictable revenue streams.
Sure. I know, to your point on the E&P sector, we've seen a number of write-downs. Just in the past week, we saw, when we're recording this here in the middle of December, we saw Chevron just took a $10 to $11 billion write-down on some of its natural gas assets. And you've teased this, and maybe I want to pull the thread on this a little bit more. There's been a lot of pessimism, negativity around the E&P players, around, Chevron is a fully integrated player, but particularly around these independents. Do you think that pessimism really is warranted, and that we're seeing a sustained period where those companies aren't going to be able to perform in today's environment?
Yeah, I to some degree, I think absolutely. The independents, for those of us that went through 2014, 2015, 2016 and watched oil bottom in the 20s, and then this new emergence of capital discipline that we saw in the year and a half or so after that, kind of felt optimistic that, hey, maybe this sector of the market, these guys that are they live and die by commodity prices, maybe they finally got it figured out. But I mean, here we are 3 years later, and guess what? They're still hammers, and everything they see is a nail, and it's all about drilling more wells as being the solution. And it proves that it's not a sustainable answer. You can't blow through capital when commodity prices are rebounding, and expect to be in a position to do well when commodity prices don't necessarily hold up. But with that said, I look at you look at the Spider E&P index, the ETF ticker is XOP. It's down like 29% year to date, and I think it might be at like an all time low. If it's not an all time low, it's very close to it. Um, I can't help but wonder if maybe there's taking a basket approach and buying that index is not is if there's not some opportunity. But it's such a hard business to make money in, especially with so much secondary gas being produced from oil drillers. It's just I'm not sure. It just really scares me away from that segment.
I agree with a lot of what Jason said there. It's been just so tough to pick winners in this sector. I mean, they just burn through capital like crazy. But however, it's been interesting to listen to how managements have kind of changed their tune the last couple of years. There's been this talk about how much free cash that they can generate. And they're starting to use that in shareholder friendly things. A lot of them have started paying dividends, they're doing share buybacks, and I really like that. I think that's a big positive. And if as more companies kind of get on board with that, I think that'll be a positive for the sector because they're really shifting away from this drill baby drill thing to, hey, let's try to make our investors some money. And a lot of it can do this. They can grow at a decent rate plus generate free cash flow in like the $45 to $50 a barrel range, which, as we're recording it today, oil's around 60. So, I mean, they're making a lot of money. It's just that it hasn't boosted their stock prices yet. And so it'll be interesting to see if that yet starts happening as they buy back their shares. And that's why I'm optimistic, especially on the lowest cost producers. I think they could really make investors some money.
Yeah, I think it's something we'll continue to follow here. Certainly, as we move into this, I guess the 2010s were the first real full decade that shale was involved in the energy markets. In the first part of that period, you could see how the markets were very much focused on growth and how can I show increased production year over year. As you see, as both of y'all mentioned, focus turned more towards cash flows. Maybe we'll see some consolidation in the sector. The environment has definitely changed when it comes to the need for profitability and the focus on getting those costs down. Another important story that we're seeing really materialize this year, but it's been talked about the past several years, is the Saudi Aramco IPO. I mentioned in the off the top of the show how the S&P 500 energy sector is now smaller than Apple. Well, Saudi Aramco by itself is around $1.7 trillion today, so bigger than Apple. This company just came public. We don't have a ton of information about it. But what should energy investors, be aware of with this business? How significant is this IPO for the sector and for energy markets more broadly?
Matt, you want to go first on this one?
Yeah, I'll take that. I think it's a good thing for investors for that Saudi Aramco's public because they've been able to kind of manipulate the market behind the scenes, and they won't be able to do that so much. Now they've got a different class for for lack of a better word to answer to, which is investors. Now, whether they'll run their business for investors or run their business for the Kingdom of Saudi Arabia remains to be seen. But if they don't, they're going to have a lot of upset people that bought into this IPO. So I think that they might keep a lid on their production, and that should boost the oil prices. So I think it's a net positive for the market.
So I I agree. I think it is a net positive for the market in terms of potentially getting a little more information again about the absolute the gorilla in the global energy room. There's no doubt about that. But I think I can answer Matt's questions that remain to be seen about how Saudi Aramco is going to manage this business, and it's going to manage this business. I think this is my prediction, exactly the same way it has. The Kingdom of Saudi Arabia is still by far the biggest investor. Will always be the biggest investor, and I think that it will not blink to do things that are still in the kingdom's best interest if they're not in shareholders' best interest. So with that said, I think, Matt, I don't want to speak on your behalf here, but I think you'd probably agree with me. I don't think this is an investment that retail investors should consider. I don't think there's enough upside. I don't think there's enough value. I don't think there's enough downside protection when there are plenty of appropriate investments that you can make that would give you, great returns or income or whatever your focus is. But I do like the fact that it's there, that it can maybe give us a little more information. But I don't think it changes anything about what Saudi Aramco does or why it does it.
Yeah, I agree with Jason there. It's interesting to watch, but not something that I would put my money in.
To both of y'all's points, this is a company that I think should be the poster child for what political risk when it comes to investing in a company. The Aramco example highlights something that's more broad to the energy sector, is just how intertwined the energy industry can sometimes be with both government policy and regulation. And I think today that we see that in no other more apparent way than concerns about climate change and what actions the government should take along those lines. We just saw Greta Thunberg from the climate strike be named the Time Person of the Year. We saw the EU announce a new Green Deal this past week, and we see the 2020 election is coming up this year. So from the perspective of an energy investor, what will you be paying attention to on this policy government side of the market when it comes to your investments?
One thing that I've noticed that companies are already talking about is the possibility of fracking bans on federal lands. Some of the candidates on the Democratic side have said that they would institute permit moratoriums on granting permits and things like that. And that's one of the things that's kind of weighed on the US E&P sector, because a lot of these companies, especially in places like the Permian Basin, that's all federal land, or a lot of it's federal land that they've leased from. And so that could impact their ability to grow. It would shift where they can grow, and they might not be able to, drill the highest return well. So that's something that, could definitely weigh on the energy sector. If a candidate with one of these policies kind of comes to the forefront later this year.
Yeah, I think that's definitely the kind of the big one. If you wanted to call it a macro thing, that's definitely the kind of the macro thing. But I think a smaller thing that's is pretty important, but I think it has a bigger material impact on certain smaller companies. The alternative fuel tax credits. There's some of our listeners are probably aware of something called the tax extenders, I think, or it's just this bucket of tax credits that historically over the past decade or 12 years, that they tend to get renewed like kind of close to the end of the year every single year, and then every once in a while they don't get renewed, and then they get renewed again and made they grandfather in the period that wasn't covered, and then they get extended for 2 or 3 years. So anyway, the alternative fuel tax credits have an outside benefit for companies like Clean Energy Fuels. It's a small natural gas for transportation company. For somebody like Clean Energy Fuels, if this credit wasn't in place this year in 2019, if it gets reinstated, it would be and made retroactive for 2019 and all of 2020. The company would probably get a cash tax return just on this one credit that would be enough to pay off all of its debt. And the company's been working to clean up its balance sheet, made a lot of progress, but to be able to say, hey, we have no debt, and by the way, we've got an extra $50 million in cash, would be a pretty powerful thing. So I think that's one of the things I'm kind of watching, and I think you'd see more push for that if there was a Democrat in the White House, and maybe Democrats took a little bit more position in Congress. But yeah, we'll see what happens in November.
Yeah, I think, Jason, to your point on tax credits as well, we're seeing, I think, starting in 2020, the solar investment tax credit starts to sunset. We see starting in 2020, Tesla and GM will be the first EV makers that will see their federal tax credits start to roll off. And there has been talk several times about extending those tax credits that have been done in the past. And that would be another significant tax credit to follow this year, particularly as EVs and solar become a bigger and bigger part of the future of energy. As we kind of move on to talk about kind of some themes of the energy market that folks should pay attention to, I got a few kind of questions to ask you guys about. So first off, what's one thing you think that people get wrong about the energy markets or about investing in energy?
I'll take that one. That's one of the things that's been kind of surprising to me to learn over the years. Is it's not driven by fundamentals as much as I thought, but sentiment plays this big role in how well like oil stocks perform. And we've seen that this year. The U.S. oil benchmark WTI is up like 27% right now, and however, oil stocks have underperformed. They're the one of the big ETFs that follow oil stocks is actually down this year, and that's different than what we've found over the past. So there's been this big dislocation in recent years with fundamentals and sentiment, and a lot of that I think is driven just by the fact that it's been so hard. Things have underperformed for so long that investors just have kind of given up on the energy market in total. And it's not just retail investors. We've seen through the capital markets, it's almost impossible for oil companies to issue stock or to sell or to get new debt at good rates. So there's just been this huge change in sentiment that's been made it really difficult for the market to operate. And that's just not the way it's always been. So that's something that investors really need to learn, is that, even though oil prices are up doesn't mean oil stocks will go up.
Yeah, I'm going to kind of chime in on that, just to kind of further show some numbers to kind of prove that out. The oil and gas explorer and producer ETF, XOP, I think it's going to probably finish 2019 down like 20%, between 15 and 20%. I think it'll probably end up down like 35% from the high that it hit early this spring. And West Texas crude's going to finish the year up between 25 and 30%, right? So we're talking about, again, the companies that directly benefit from higher commodity prices as a group. Sentiment, their stock prices as a group are going to be down double digits while commodity prices are up double digits. I mean, that's it. But I think the other part of it too, and I think this ties to it for me, is, I think a lot of investors view renewables as this panacea that's going to kill fossil fuels over the next decade or 20 years. And certainly, I think the oil industry is dying. It's just not dying yet, and it won't die quickly. We're talking about it's going to take 30 or 40 or 50 years for the oil industry to quote unquote die. Renewables are just a bare fraction of the global energy market. And even as they grow and become a bigger fraction, oil and gas are going to remain a dominant way we power the world. Yeah, I think none other than Bill Gates is a pretty big proponent of nuclear energy. For those reasons, I think he also points out the needs for like industrial energy, and how nuclear just there are parts of the industrial chain that are going to continue to produce massive emissions, no matter all the other pieces of it. And nuclear can and probably should be a big part of that no emissions power. So yeah, I think you're probably right.
All right, next kind of segment. Do either of y'all have a bold prediction about the energy market for 2020?
I do. I think that there's been a lot of mergers and acquisitions in the energy market in the past couple of years, but I really think that 2020 is going to be the year that we just see a ton of mergers and acquisitions. But I think what's going to be different is that we're not going to see these huge mega premium deals. Like earlier this year, we had Chevron bidding on Anadarko and then getting outbid by Occidental, and just this huge debacle. I think we're going to see a lot of what would be called merger of equals, where there's no premium deals, straight up stock for stock. The reason being is these companies just need scale to drive down costs, and the only way they're going to do that is to join forces. So I think we're going to see just a ton of mergers. I've got some that I'm kind of keeping my eye on. I really think would be good fits. So my bold predictions for this are: I think Devon's going to buy Marathon Petroleum, Diamondback Energy is going to buy Concho Energy, and then ExxonMobil I think is going to make a big buy and merge with ConocoPhillips.
You're not messing around, Matt. That's
Yeah.
you're stepping out there.
It's some
Yeah.
bold.
It is. It is. Of those, honestly, I think that the Exxon Mobil buying ConocoPhillips, I think that might strike a lot of people as just, whoa, that's crazy. But that's actually a really good fit. I think that really is a really, really good fit. I'm gonna go in a different direction. I'm gonna be bold. I'm gonna say offshore drillers will finally be a great investment in 2020. Um, I think they almost have to be, though, to be honest with you. I'm bottom fishing a little bit there. But seriously, I think my bold prediction is going to be that Tesla grows its solar business in 2020, and then it takes market share from SunPower, Vivint, and Sunrun. Those are for the uninitiated. Those are the biggest, residential solar installers and commercial solar installers in the U.S. I think Tesla's going to grow that business, and it's going to take market share this year.
So next kind of segment is what are y'all's? I don't want to say your top pick because that's always tough. But what energy stock would you be most excited to own going into 2020?
I've been thinking about Energy Transfer for years and years and years, and I'm glad to this point that I haven't bought because it's done nothing but go down. However, it for me it checks all the boxes. It is just so ridiculously cheap now. Right now, it trades at 8 times its earnings. Most midstream companies trade at 10 plus times earnings, so it's just so cheap, and it's because it's growing its earnings even though its stock is falling. It also pays just an enormous dividend. It's 9.7% at this moment, and it generates enough cash to cover that 2 times, which is really safe as far as coverage goes. It's a master limited partnership, so they typically try to do 1.2 times coverage. So it's a ridiculously margin of safety there, and they've done a good job, fixing up their balance sheet to get their leverage down. So I think that's a safe payout. I think they might actually start increasing it in 2020 because they're growing earnings. They grew their earnings double digits for like the past 5 years. They're on track for another double-digit earnings growth next year. They just bought Sun Group, which will give them another oil port. They're integrated into oil exports, and I think that's a big market. They've got a lot of organic expansion. So I'm really tempted to buy that. I think I will buy that. That's the one that I think has the potential to do extremely well next year.
It's funny. I think to a certain extent, Energy Transfer lately has kind of been a product of its past a little bit in terms of it's had some challenges that it's had to work through over the years, and then you have the sentiment where where it's just kind of blocked in as a quote unquote oil stock. But I think you're right. I think a lot of times people see that nearly 10% yield, and it's like, wow, that's got to be a dividend trap, right? This is, something bad's going to happen. I'm not going to buy it, and then they're going to cut the dividend, and then the stock's going to fall 30%. I'm not falling for that Energy Transfer, but I think you're right. I think it's just such a it's an opportunistic chance to buy one of these guys that you buy usually for yield, but you probably get some really good capital appreciation because the value is just it's so cheap. So with that said, I'm gonna go a similar, slightly different direction. I'm gonna go with an expensive renewable energy company, Brookfield Renewable Partners. The stock has absolutely been on a tear, but I think deservedly so because it's a great company. It's part of that Brookfield group where they know how to manage assets. They know how to invest in assets that make money. I'm going to say this is one that I don't know if I'd necessarily buy today if unless I just didn't own it. I think it's worth starting a position today, but I have a ton of it. So I'm going to say that's my own forever. If I was going to buy today, my buy now is Tellurian. We did a show not too long ago, Nick, about the LNG exporters, liquefied natural gas exporters. Tellurium is one we talked a lot about. It's got great management that have a solid operational background from their time at Cheniere. It's got co-founders that are still really involved. It's got great prospects. It's a little higher on the risk scale because they still don't have a business. They're still just in the early stages of planning out and getting ready to build. And they're going to have to spend upwards of $30 billion to build this export facility and a couple of pipelines. But they have the right team in place to do it. There's a huge opportunity, and I think after the recent kind of tumble the stock's taken, I mean, I think 5 years from now, there's a realistic possibility this is a 10-bagger stock. Even if it's not a 10-bagger, I think that it has a better than average chance of absolutely crushing the market over the next 5 to 10 years.
Yeah, absolutely, Jason. We discussed we did that show maybe a week or so back. You have the management in place there at Tellurian that's done it before, an opportunity before you from a macro point of view that just really sets up nicely for them. And so you can really see the way things could line up, and it could really be a very successful stock. I think for me right now, I don't know if I have an individual stock pick, but I do think going off some of the themes that we said earlier about how we think there's going to be continued consolidation in the E&P space, about how energy prices are low relative to the value that these businesses provide. I think companies that are alternative asset managers that are sources of permanent capital are well positioned going forward. So we talk about Brookfield Asset Management a lot on this show. Jason mentioned Brookfield Renewable Partners. We talked about the merger between Occidental and Anadarko Petroleum earlier this year, that Berkshire Hathaway was really able to extract incredible terms out of that deal as the capital provider there. You look at how low interest rates are over time. I think you're really well positioned to invest in one of those kind of alternative asset management companies, whether it's a Brookfield or whether it's Berkshire Hathaway or a company we're going to talk about on this show. I think next week it'll be have already been out by the time this show comes out. Is Lowe's, a company that touches a few of these areas. They have a stake in Diamond Offshore, but I think
so. And by Lowe's, you're not talking about the home improvement company.
Yes, LOEWS.
The other Lowe's, right?
Yes. But I think these sorts of companies that have permanent capital and are well positioned to invest going into the future, I think are a place to look in the market. All right, moving away from energy and more towards the new year and investing as we close out. Matt and Jason, what are your New Year's investing resolutions for 2020?
Well, one of the things that I know I struggle with as an investor sometimes is I tend to be really risk averse. That's why I like things with predictable cash flows and high dividends. And even though those have tended to have more risk than I expected, I want to be a little bit more risky with some of my energy picks, especially on the renewable side. Renewables is just this multi-decade trend. And so I think buying renewable stocks this year, even though they've been crazy, like Jason mentioned, Brookfield Renewables been gangbusters. A lot of solar stocks are up triple digits this year. However, when you're looking decades out, I think the renewables is just going to be the place to go. So with really $1 or $0 commissions, I want to just take advantage of buying renewables and build a basket of different renewables to go with my lower risk Brookfield position in Terraform Power and some of those. But I want to add some solar panel makers and some maybe wind turbine type stuff, and just build out a really nice portfolio of renewable stuff to just benefit from this long term trend.
Yeah, Matt and I were chatting on Slack a couple of weeks ago. We were talking about Pattern Energy, which recently reached a deal to go private. And I've been a big bull on Pattern for the past maybe year and a half or so, a couple of years. Stock's done really well with some risk. And Matt, I think the last thing Matt said to me in the email was eventually he would learn, talking about that. So I want to laud you for taking this approach. And I agree, $0 commissions, such a great way for investors. I don't think people should use it as a reason to trade more, but I think people should use it like you're talking about as ways to build more diversified baskets, because you can throw a few $100. You got 5 or 6 companies you like in an industry, and you don't really know which one or two you want to buy. There's no reason now why you can't spread your capital across the entire basket and build some diversity into a sector that you like. And then you don't have to worry about trying to pick the winners and avoid the losers. And I think it can pay off. Ironically, though, my resolution for 2020 is to make fewer, bigger bets. I've always been one to kind of spread my capital around. I own well over 100 individual stocks. But as my knowledge and experience has increased, um, I think I've identified, half a dozen to 10 stocks that I own a little bit of that I really like a lot, and it's time for me to start making some bigger bets. Specifically, I'm looking at renewables, some global infrastructure companies, and some real estate investments that I some REITs out there that I really like a lot.
Yeah, I think those are great things to work on for the new year. I say for my part, I think I've become, I guess, more hesitant to just invest every month. I've gotten out of the habit of investing a set amount of money every month and tried to pick and choose a little bit more than probably I should with timing the market. So I think my resolution is for 2020 to buy the same dollar amount of stock every month. And, whether I'm whatever my thoughts are on the market, making my, whatever I think is the best stock to buy at that time each month. I do think you guys missed the one big important part of this $0 commissions and corollary everybody moving to fractional shares. Robinhood just came out, they're going to allow fractional shares, is that I can tell everybody I'm a Berkshire A shareholder now, starting next year. So all our listeners, you can do that too, and we can make everybody think we're superstars because we own Berkshire A. And for folks who don't know, the Berkshire A shares are the ones who sell for $300,000 a pop. Unless you've been hanging out with Warren Buffett for a long period of time, you need to be a superstar to be moving those around. But I tell you, as soon as we get access to fractional shares, the first thing I'm buying were Berkshire A shares. All right, y'all. Thanks so much for coming on the show, as always. And I hope all our listeners enjoyed this preview show for 2020. We bring in lots more coverage of the energy and industrial markets as much as we can. Thanks for coming on, guys.
Thanks for having me.
Thanks. Happy New Year to you guys.
Happy New Year. As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed, so don't buy or sell anything based solely on what you hear. Thanks to Dan Boyd for his work behind the glass. For Jason Hall and Matt DeLallo, I'm Nick Seipel. Thanks for listening, and Fool on.